Welcome to this deep dive where we take a stack of information, in this case, the analysis of a crucial earnings call, and really pull out the signals you need.
And today we are focusing on PriceSmart, or PSMT, for its Q1 fiscal year 2026 earnings call. That was held just a couple days ago on January 8th.
Right. And if you're wondering why we're focusing on this specific company, you really have to understand their unique footprint. This is not your average Costco.
Not at all. PriceSmart is the big warehouse player across 14 countries in Central America, the Caribbean, and Colombia. They're running that same high-velocity, low-margin model that, demands incredible scale and efficiency.
But they're doing it in some of the most diverse and, frankly, volatile international markets on the planet.
And that's the whole story right now. It's this core tension. On one hand, they're a classic trade-down winner. Inflation hits, people flock to warehouse clubs for value.
So their demand just explodes.
Exactly. But on the other hand, trying to convert that amazing top-line growth into clean, predictable GAAP earnings, well, it's a constant fight against foreign currency swings and just complex local operational issues.
So that's our mission today. We need to figure out why that consumer demand engine is roaring so loud, and then pinpoint the exact friction points holding back the profit.
And maybe most importantly, map out management's big investment plan to see when that friction might finally start to ease up.
Okay, let's jump straight into the numbers because the headline really defined the entire quarter. It was a classic divergence.
It really was. I think when the results first dropped, the initial reaction was probably a bit of confusion. On the earnings side, you had GAAP EPS diluted, that's your main profit number, coming in at $1.29.
Which was a miss.
A miss, yeah. By about 6 cents against the consensus of $1.35, so a 4% shortfall.
Okay, a clear miss there, but then you look at the other side of the ledger, revenue.
And revenue clocked in at $1.38 billion. There's a solid beat of about $30 million. It represents, strong year-over-year growth of 7%.
So an EPS miss and a revenue beat. And here's the real kicker. Despite missing on profit, the stock closed up 4.55% on the day of the call.
Yeah.
So how do you miss on earnings and stock jumps more than 4%? What did the market see that the strict accounting numbers miss?
The market's verdict was pretty clear. Investors are willing to look right past the near-term margin friction. They're ignoring the tax noise.
They're focused on the sales momentum.
Exactly. The raw velocity of the business, the durability of their demand model. For a warehouse club, that's key. If you have the traffic and the volume, the efficiency can follow with the right investment.
And the raw numbers really confirm that story. Net merchandise sales, so that's goods sold before membership fees, were up 10.6% year over year in US dollars.
And even if you adjust for currency swings, what they call constant currency, growth was still 9.5%. That's very strong.
But the number that really matters for this model is comparable net merchandise sales.
The comps, yeah. That measures growth in your established clubs. And that was up a very, very strong 8%. When you see that kind of organic growth, you know the engine is firing on all cylinders.
And it's not just a healthy engine. It's one that shows the growth is volume-led. That's the signature of a successful warehouse club. Transactions, the number of times people walked in and bought something, grew 8.4% year over year.
And that just blew past the 2.1% growth in the average sales ticket. This tells you the volume is real. It's not just inflation.
Right. People are actually buying more stuff, filling their carts, coming back more often. That traffic velocity is everything for this model.
And what secures that traffic is their membership structure. Total active accounts are now over 2 million. And that 12-month renewal rate is incredibly sticky at 89.3%.
Once they get you in the door, you tend to stay.
You stay. And what's really interesting is the strategic push they're making on the premium tier. The Platinum membership. This gives members annual cashback reward.
Which drives huge loyalty and encourages even higher spending, right?
Precisely. They noted Platinum now represents 19.3% of their total member base. That's a huge jump from just 14% a year ago. So they're actively upgrading their most loyal customers.
And you see that immediately impact their high-margin income stream. Membership income as a percentage of revenue ticked up to 1.7%. From 1.6%.
It's like they're training their best customers to be even better customers. And those fees, they drop straight to the bottom line without the cost of goods sold.
If we look at the actual categories, demand was pretty broad, but it was focused on essentials. The core foods category grew over 11%.
But the real powerhouse was their health services segment. So think optical, audiology, pharmacy. That segment grew a massive 17.8% year over year.
17.8%. Wow.
It's huge. It shows they're becoming more than just a bulk grocery store. They're becoming a critical provider of essential, higher value services in these markets.
Okay, so let's pivot to the flip side of this, the operational drag. Despite the incredible top line, you've got these external factors and internal investments just eating away at the profits.
Yeah, and we can start with gross margin. That line was basically flat at 15.9% of net merchandise sales. They're holding their own on pricing, but they're not gaining any new efficiencies there either. Not yet.
The real pressure point was below that line in SG&A. For our listeners, that's selling, general, and administrative expenses, basically, your overhead.
And total SG&A increased 30 basis points to 13.1% of total revenues. That's a noticeable increase in overhead.
So what's driving that?
Management basically pointed to two main things. First, continued heavy investment in technology across the board, which is, necessary future-proofing. And second, the compensation of the new CEO.
Oh, right. That compensation explanation is interesting. The previous CEO was interim and actually declined compensation for a long time.
Yeah, from February 2023 to August 2025. So this increase is really just the salary being recorded again, which bumps up the SG&A.
So it's sort of a one-time adjustment, but it still makes the numbers look a little messy.
It does. But if you're looking for the single biggest source of the bottom line miss, it wasn't overhead. It was currency volatility. They recorded a $7.2 million net loss in total other expense.
This is just the cost of doing business internationally.
It really is. Think of foreign exchange losses, or FX, as a leaky faucet. Every dollar they earn in local currency is potentially worth less when they bring it back to US dollars. And that loss, almost unchanged from last year, shows that they're still fighting the currency war.
And that messiness even leaked into their taxes. They reported a higher effective tax rate, 27.9% compared to 26.5% a year ago.
Yeah, and management blamed that on non-recurring items, like tax contingency approvals and those same unpredictable FX rate fluctuations.
So if you tie all these threads together, the story really holds up. The core business, the volume, the traffic is rock solid.
But the external constraints are just making that final profit number volatile and hard to read. That 7.2 million FX loss is a big headwind, but it's one the market is clearly willing to forgive for now.
Okay, let's dig into the actual execution on the ground. Management gave a great window into country-specific dynamics, and Colombia just keeps being the standout success story.
Absolutely. It contributed a massive 320 basis points, that's over 3%, to consolidated comparable sales growth.
So what are they doing right there?
Well, management credits strong local operations, but also, a favorable tailwind from the Colombian peso strengthening. It was trading below 4,000 to 1, which really helps local purchasing power.
And that ties back to their corporate philosophy, right? They mentioned being able to pay a living wage above the local minimums.
Exactly. When the local economy cooperates, it gives them the stability to maintain those standards without worrying about sudden policy shocks.
They also touched on the slight slowdown in December comps.
Yeah, those came in at 7.1% in US dollars. But management was really quick to call those headwinds transitory, temporary problems.
Like what?
Well, specifically, consumer uncertainty in Honduras is easing now that the election is over. And in Panama, an extended rainy season was causing all sorts of traffic and logistics nightmares.
But the dry season is arriving, so that should resolve itself.
Right. But the critical point for investors was the supply chain issues. They admitted to temporary out-of-stocks in some high-volume food items. For a warehouse club, being out of your core items is it's kryptonite.
A cardinal sin. And management knows they have to fix that immediately.
And then there's the one issue that just perfectly symbolizes all this friction. Trapped cash. The CFO noted they had $80.2 million in cash and equivalents in Trinidad.
$80 million.
Yeah, denominated in the local currency. They just could not be readily converted into US dollars.
Because it's just stuck there.
It's stuck. Money they've earned just sitting there, unable to be deployed or repatriated. Management says it's typical for Trinidad, especially post-holiday, but it's a huge, persistent challenge. It is the leaky faucet at its absolute worst.
Okay, so to fight these long-term drains, they're pushing hard on strategic investments in real estate and tech. This is the bull case.
This is the bull case. On the real estate side, they're expanding from 56 to 60 clubs. We're talking new clubs in the Dominican Republic, a 10th in Costa Rica, and 2 more in Jamaica.
And it mentioned the Jamaica timeline was adjusted because of Hurricane Melissa recovery, which again just shows the kind of volatility they're constantly managing.
It does. And then, of course, the big strategic headline is their confirmed entry into Chile.
Right. They've already hired a country manager, signed agreements for 2 sites. Why Chile?
Well, management noted that Chile is a super competitive market, but, and this is the key insight, it's a market that is currently free of their specific club model. They see a clear opening.
They think they have a right to win there.
That's the phrase they used, which tells you this is a high conviction, major future catalyst for them.
And it's not just new clubs. They're also overhauling their supply chain.
A heavy lift. They're opening new distribution centers in Trinidad, Colombia, and the Dominican Republic this fiscal year. This is about improving availability and lowering those landed costs that pressure margins.
And the brain behind all that new infrastructure is technology. They mentioned the Blue Yonder platform.
Yeah, they're on track to fully implement the Blue Yonder forecasting and replenishment platform in fiscal 26. For listeners, Blue Yonder is a massive supply chain AI tool. It's designed to boost inventory management and directly fix those in-stock issues they had.
And all that tech spending is really justified by their online growth. Digital sales hit almost $90 million, up nearly 30% year over year.
It's now 6.6% of total merchandise sales. That's a highly profitable channel, and it's why they're investing in things like migrating their mobile app to a fully native architecture.
So, a remarkable story of execution under constant pressure, which I think brings us to the segment where we let those constraints drive a hypothetical and maybe slightly outrageous trade idea.
This is not financial advice segment. We're just connecting specific high-friction data points to potential opportunities. This is purely a thought experiment. Do not trade off this.
Okay. And the core of this trade centers on that exact dichotomy we've been talking about, the amazing underlying volume versus all of that visible operational friction.
And our thesis here is centered entirely on that trapped Trinidad cash.
The $80.2 million that they can't convert to US dollars?
That's the one. The idea is a paired trade. Long PSMP equity, hedged by a short position against a specialized LATAM Caribbean fund, or maybe a competitor with heavy, unhedged exposure to the Trinidad dollar.
Okay, so why the hedge? If demand is so strong, why not just go long on PriceSmart?
Because the Trinidad FX issue is a known, persistent problem. The market knows about this friction, and it's already discounting the company's cash flow because of it. If the Caribbean macro picture gets worse, that hedge protects you.
So you're not betting on the whole region improving, you're betting on a company-specific solution.
Precisely. PriceSmart is actively building a new distribution center in Trinidad right now. They're investing heavily in these supply chain platforms. We are betting that operational excellence, better infrastructure, smarter inventory will eventually force that FX pipe open.
So if they find any way to successfully convert that 80 million, or if the local situation just normalizes faster than anyone expects,
that trapped capital instantly becomes available. It acts as a sudden asymmetric catalyst. That $80 million unlocked gives them a huge boost to cash flow that completely outweighs the short-term SG&A and tax hits we saw this quarter.
So you're essentially betting that the massive supply chain transformation isn't just about moving pallets more efficiently.
It's about moving money more efficiently. It's an asymmetric bet on superior operational deployment, solving a financial problem.
That is a fascinating way to frame it. Looking at CapEx not as a cost, but as an investment in releasing trapped assets.
Yep.
Okay, so to wrap up the overall takeaway from this quarter, the call really solidified the bull case. Demand is incredibly strong, driven by high traffic and loyalty.
But the challenge remains converting that phenomenal top line into clean, predictable earnings because of all the local friction, FX, logistics, you name it.
And the market, for now, is rewarding that execution story. They believe management has the right plan to solve the operational side of the equation over the next year.
Which leaves us with a provocative thought for you to mull over. Given the strong focus on high-value platinum memberships, now almost 20% of the base, and this massive technological investment in their supply chain like Blue Yonder, how much longer can this margin volatility really persist before that operational discipline finally takes over and delivers a truly clean quarter?
We leave you with that question to explore.
Thank you for joining us for this in-depth look at the PriceSmart Q1 FY26 earnings call.
We'll catch you next time for the next exploration into the numbers.